That's why there's a good chance that mortgages will remain relatively unchanged for the near future, unless the Federal Reserve starts buying the 10-year Treasury yield in an effort to pump more money into the market and drive those yields down, which at this point, nothing would surprise me anymore. Plus, if they actually did do that, it's probably a sign that investors have lost faith in the US economy, and it's a bad sign. Anyway, barring the Federal Reserve purposely stepping in to bail out the housing market, realistically, housing prices will continue to soften as more inventory gets listed on the market, and prices might begin to decline relative to inflation. On top of that, national home prices have remained fairly stable, so it's unlikely we're going to see a crash, but a softening is definitely something that's in the cards. Although a bigger problem right now might actually be the stock market. Unfortunately, we have a few variables all affecting stock market performance, with the first being treasuries. Like I mentioned earlier, for the foreseeable future, the long-term treasury yield is going to act as the barometer for our entire economy, because this is seen as the risk-free rate of return that every other investment is compared to. Like, to put this into context, if the 30-year treasury offered a risk-free guaranteed 10% rate of return, why would you invest in the stock market where you might get an average of 8%? Or why invest in real estate for a 7% return when you could invest in this with no risk or work whatsoever? That's why the more these long-term yields offer, the cheaper other investments need to become in order to compete. And this is what brings us to the first issue.